Good morning and welcome to our first edition of Morning Tip TV. I'm very excited to be joined by my co-host, Charlie Gibson from Edison Investment Research, Global Head of Metals and Mining, and Ian Williams, who is the CEO and Chairman of Charteris, and he's also the Head Fund Manager for the Global the Metals and Mining Fund as well. And so we're going to begin with our first slide, which is going to show us the current metals prices across the globe. And we can see that gold is off a little bit today, but all the base metals seem to have a bit of a bounce from yesterday after the China data that came out and caused a weakness in most of the base metals. Today we have the ECB meeting, which I think is everyone's sort of waiting in anticipation for the results of that, hoping for some quantitative easing going on out of that meeting. And if they don't get that, we could have a little bit of a sell-off in the metals again. So let's go with our next slide that we have. And here we have the gold price, thanks to Charlie. And we can see yesterday we had a bit of a sell-off in the gold price of about $25 and a little bit of weakness today, but it looks like it's holding steady for now. And let's go to our next slide. So here we have
This is quite a busy slide,
yes.
But I suppose what it shows, the interesting thing that it shows here, is just how much of a rally we've seen in some of these metals. So these are relative metal price performances since the 1st of January 2015. So you're looking over a year and a bit period. And what you see is of those metals, and we're going from the precious, the gold and the silvers, through the sort of bulks, the iron ores, and then the steel related like the zincs and the nickels. And what you see is gold and silver leading that, and they've been pretty consistently strong for at least the last 6 months. But then what's really interesting is you see this big sell-off in uranium in the last, well, what month, and this big bounce in iron ore. Iron ore is now, of these 1, 2, 3, 4, 5, 6, 7 metals and minerals, oil is there as well, iron ore is now the third best performing.
Well, it has been said that the bounce in iron ore was due to a horticultural show in China, that the government has requested all the steel mills to close from April till October, so they've decided to ramp up production prior to the halting of the steel mills from April to October. But this is what China says. Who knows what they say?
Well, I know also what they say is the Deputy Secretary of the China Iron and Steel Association has said, don't let wild short-term price swings distract us from our analysis of the market, which I think might be China talking its own book, but they're definitely sticking with their party line that the iron ore is structurally oversupplied and the price should fall. So I was just wondering, do you think that the flower shirt Chelsea has this problem? Whenever there's a, do you think at Ravenscraig they get a telephone call saying, I'm sorry, there's a flower show at Chelsea, you've got to close production now? So
could be
only in China, I think. But anyway, and you also see, I mean, I think on that chart also you can see the bounce in oil as well. I mean, these are actually pretty significant bounces from the depths of, well, it was only one and a bit months ago now. So, but you know, these are big moves, and there is money to be made on the back of them, I would suggest.
Well, I don't know. I mean, Goldman Sachs, who likes to ruin everybody's party, came out yesterday saying that they don't see these prices in metals being sustainable.
Do we think they might have a proprietary short position?
Well, as we do, they like to talk their own book for sure. And it's also, they say that copper prices are going to fall 20% in 2017. So let's stay tuned and see if
that's funny,
right.
because that's in complete contrast to Freeport-McMoRan overnight, saying that they see the copper market moving into a structural deficit by 2017.
Well, I'm going with Freeport on that.
Yeah, absolutely, we're going with Freeport on that one.
Let's go to the next slide, please.
And then this is just sort of interspersing some of those metal prices. Really, it's over the same time span, but just with some of the major miners. So you've got Rio Tinto there, you've got BHP, you've got Glencore. What's interesting, you know, pick of the bunch, Randgold Resources, all right, is in the top performing metal, which is gold, and then you get the geared effect on that. But you can see that is a pretty striking, Randgold Resources at the top. That is a pretty striking price move. And then at the bottom you've got Anglo American, you've got Glencore, and but you've also got BHP and you've also got Rio Tinto. And what's interesting about this is if you look over this period of a year and a bit, you're seeing the major miners are underperforming their metals. So all of those companies that I just mentioned have underperformed copper and they've underperformed iron ore over in a year and a bit. However, if you go to the next slide, what you'll see is that there has been a colossal bounce since now. January the 20th I picked because that was Anglo-American's low, and then I just rebased everything to that and then said, well, what are the share price moves? You see, since January the 20th, so what is that, a month and 2 weeks ago or something, Anglo-American is up 2.4 times, and that's with a pretty significant retracement in the last week or so. It was, you very nearly tripled your money in dollar terms. In sterling terms, I think you did triple your money. Same thing with Glencore, you're up, you made double your money. Randgold Resources, a little bit less, but actually still more than BHP and Rio Tinto. So you really see the geared effect, I think, coming through there with the likes of the Anglo-Americans and the Glencores. Exactly. Okay, well, let's have the next slide. So this is just showing, I suppose, the same thing on a slightly larger scale, but also just showing the outperformance of gold versus the general indices as well. So gold there is the middle green line, hugely outperforming the Dow Jones and the FTSE 100 index. Again, in US dollar terms, gold is up 20%. Those two indices are both down 2 or 3%, but when you compare the two together. And then again, if you look at the Arca Gold Bugs index and the FTSE Gold Mine index, which is the two top lines, you can see that they have actually given you a return in dollar terms 60%. And so are you still positive on the gold price? Yeah, I am actually. I mean, what with gold is $12.50 at the moment. I mean, fundamentally, I think that a price more like $13.50, $1400 is the price that now, you know, when it gets there and how it gets there. Yes. is a matter of infinite speculation. But do I think it's fundamentally, fundamentally there is potential for it to rise? Yeah, absolutely, I do. Excellent. All right, let's look at the next slide. Which I think this is just my final slide, and that's just looking because it's an interesting reflection of where performance is in the sector. These are almost all gold counters we're looking at here. They're almost all London listed. It's just comparing to the price of gold. This is since 2010, so that's when Acacia, as it was then African Barrack, came to the market, which is why I'm rebasing it to that point there. But you can see there's this little, this very select group there. You can see that line across the middle. That's what the gold price has done. And in relative terms, there's a very small little select group of Randgold Resources and Pan-African, certainly of the producers. And I think I'd add Caledonia Mining, who's just fractionally underperformed. But those three, and then you've got the two explorers in there as well, Trans-Siberian and Condor Gold. But Condor Gold really showing why you're in the sector, up 3.5 times relative to a gold price, which is up since 2010 as well. And you get those producers, but then that long tail of underperformers there. I can't immediately count how many there are, but there must be, what, 15, 20 counters there, which have underperformed, not only underperformed a rising gold price, but underperformed quite significantly as well. So, you know, really just demonstrating where the quality has been, I think, and where the returns are to be had, and actually it's in a surprisingly narrow segment of the market. Yes, and part of the rise in the Condor Gold could be the large investor of Jim Mellon taking a position in that company, even though they're not in production, but always good to follow the money. Yeah, and I think also, on that one, they were in a pretty uncomfortable position when this analysis started in 2010, so you are seeing a recovery from that. You know, the assets that they had in El Salvador had just been confiscated by the government, so, and they hadn't yet moved into Nicaragua. So that was you know, it also shows to some extent a recovery from there. But you know, shows where you can get your returns. Exactly. All right, let's look at the next slide. All right, and here is our slide on Glencore. As you can see, they've had a bit of a retraction today due to a fatality at their mine in the DRC. And so, well, do you think that's actually the reason, or do you just think there's a little bit of? I mean, that looks like a bit of profit taking to me, I would have said, rather than. Well, it could be that as well. It's probably a combination of both. And I would have said, because again, you know, this is fantastic. You know, under £1 earlier this year, and that, yeah, you double your money, £1.60 in sterling terms. So what do they say in the market? It's never wrong, to the old adage, it's never wrong to take a profit. So no, you can always reconsider and decide whether you want to invest again. Yes, always best to make a trade in the mining market instead of standing in there for the long run. All right, let's go to the next slide. So Ernst & Young just came out with their assessment on mining deals based 2015 versus 2014. As you can see that last year, basically deals were down approximately 10%.
from 2014, and down 34% on completed deals last year from 2014. And so what they're expecting for this year is that there would be a lot more private equity will potentially start picking up assets. They're looking at expectations of more spin-offs occurring this year, and there's going to be a lot more M&A that will de-risk and preserve capital, and also they're looking at hostile takeovers. So let's just hope this all starts to happen. As we saw the other day that Claude Resources, which I had actually told Ian last week, he said, what's the next takeover? And I said, Claude is just being taken out by Silver Standard. So that's pretty exciting news. Let's get on with the next slide, please. All right, so our guest today is Ian, who manages the gold and silver fund for Charteris. And it's basically more of a silver fund than a gold fund. So he's going to talk to us today about why he's more heavily weighted in silver stocks. And he's also going to show the performance of his fund, which has been quite spectacular. Thank you, Ian. Please go ahead.
Okay. Well, it's quite simple, really, is that in a bull market, silver has a much higher beta than gold. So in a bull market, it goes up a lot more. And our premise is quite simple. If you're bullish on precious metals, you should be long of silver rather than gold. And if you're not bullish on precious metals, then you shouldn't buy either. And as we can see, what tends to happen, if you look at the start of the market here, gold tends to kick the game off, and gold started going up while silver was still going down. But eventually silver catches up and then overtakes in quite spectacular fashion. And we're seeing the same phenomenon again happen here. Gold's broken up out of its trading range. Silver has yet to break up, but it's only a matter of time before the lag kicks in, and then you'll see a much greater percentage move in silver than you will in gold. And as a result, our fund, which is 70% in silver miners as opposed to gold miners, is then, guaranteed is the wrong word, but we're fairly confident that it will substantially outperform the other gold mining funds purely because of this phenomena.
And are you not concerned, though, that there could be potential takeovers of some of the silver companies that are in your fund at the moment?
Yeah, oh yeah. I mean, that's our biggest concern is that some of our favourite stocks, and we've already lost one or two already, get taken out before the game really kicks off. Because if you're a big mining company or a medium-sized mining company, these assets are so cheap and undervalued, it makes sense to try and buy them now. We tend to take the opposing view. We'd rather, our favourite stocks, we'd rather keep them for a while, and we'd rather get the upside rather than the buying company.
So it's humorous. If an acquirer comes to one of your companies with an offer, your instinct would be, as a shareholder, would be to reject the offer. I mean, depending on the premium, or let me ask that a different way. What premium are you looking for?
Yeah, I mean, they tend to come to the market with a sort of 35–40% premium over the prevailing price. But of course, bear in mind how bombed out these are. It's 35% of a very depressed level, and where you've got, say, a $600 million market cap company, that's got the potential to grow to a $2 billion, $3 billion, $4 billion market cap company. If that gets acquired by a $4 billion market cap company, it's much harder for and less likely that the $4 billion market cap, that will quadruple in value. So, you know, if the sector condenses down into a lesser number of bigger names, it's going to take a bit of shine off the performance.
So let's talk about
as a whole. But there's still an initial kick in.
So that $600 million company that you were talking about, which you think can go to $2 or $3 billion.
Yes.
What premium would you, if an acquirer came now and said, look, we're interested in buy it, price is 600, you think it goes to 2 or 3, what premium would you be happy taking?
Well, the trouble is we don't own enough of it to decide the outcome. So
no, but you're a man of distinction and influence. So, and as a shareholder, you can vote for it or against it.
Oh yeah,
so.
well, we would tend to rather it didn't happen, so we would vote against it. But the problem is,
but they can offer a substantial amount, enough money in the end that you'll take it. So I'm just wondering what sort of amount. You know, if they offered 1.2, would you take it?
You'd have to look at it, and you'd have to look, really, our biggest interest would be, well, if it was a cash offer, for example, you know, how will we use the cash? What would we buy instead that was as good, in our view, as the company we've just lost? Bearing in mind we've just had a fairly big premium over the prevailing price for losing those shares.
And do you hold cash, or do you immediately convert that into metal as a sort of neutral?
Into shares, yeah, we don't tend to hold the metal.
Right.
No, I mean, our view is similar to yours. We think the cycle's turned, we think all these commodities are now going up, and as a result, the minute we get cash, we tend to put it in the market. We'd only hold cash if we were bearish on the market, and then under the fund rules, we can only have 10% of the fund in cash anyway.
Right.
Do you want to see the next slide?
Okay. Well, this just underlines, again, why we think investors will potentially prefer silver to gold. This is a gold-silver ratio going back 100 years. And it's never really, during the last 100 years, gone above 100. It's above 80 at the moment, 82, 83. So it's pretty close to its all-time highs.
How do you explain that?
Well, if you look, interesting enough, at a 100-year chart of the gold-oil ratio, oil is also equally at its cheapest relative to gold for 100 years. So if you looked at the family of commodities, gold in relative terms is quite expensive relative to others. Now, silver is semi-industrial, gold is pure precious metal, and the gold-silver ratio has tended to rise. During bear markets, you see, the beta of the silver price works against, in a bear market, works against silver because it goes down a lot more than gold. So this latest move from 2011 up to the current price, silver's gone from $50 an ounce down to $13 an ounce, back up to 15. Gold's only gone down from $1,900 an ounce down to $1,100. So gold has fallen much less in percentage terms. You talked earlier on about iron ore. That's down by a massive percentage factor over the bear market. Oil is down from what, $120, $150 or whatever it got to, down to 27. So you've had massive falls in some of these commodities, and the ones that have fallen the most tend to build up the biggest short positions amongst the hedge funds, and they're the ones that bounce the most when the bear closing comes in. So you've had this strange situation where iron ore has gone up the most. Iron ore's got the biggest glut of any metal. Yeah, it's gone up the most. Why is that? Because that's where all the shorts are, and that's where all the short coverings kicked in.
But coal hasn't bounced much.
But there hasn't been that much of a short position in gold. I mean, the Russians have been buying gold.
Oh no, coal. Sorry.
So coal. No, I don't think anyone trades coal.
No one trades coal. No one.
I mean, so this is a function of partly the bear market. When you get a bear market in gold and silver, the gold-silver ratio tends to rise, and then as you get if you get a bull market developing in gold, that ratio will tend to fall. Going back to the earlier point, because you can expect silver to go up a lot more in percentage terms than gold.
So where do you think that graph comes back to?
Well, the mean, I would say, is somewhere around 40 if you look at the long-term average, but it never stops at the mean. So if that's the average price over 100 years and it's currently 80, I would think if it gets going and we get a serious bull market developing, that ratio is going to go down to sort of 20s and 30s, which means that...
And then presumably you're a seller of silver at 20, are you?
Oh, absolutely, yeah. Then
which is the old mint ratio, isn't it?
Yes, exactly. So, but can you imagine how much money, how much outperformance you're going to get in silver mining shares over gold mining shares during that run, because you're looking at silver going up several fold more than the rise in the gold price. So you're not just talking about silver going up an extra 10 or 20% more than gold. You're looking at silver going possibly from, say, I don't know, $15 up to $100, and gold going from 2,000 up to 2,400, 2,500. So the percentage rise in silver is going to be far greater, which will take that ratio down to closer to its long-term 100-year average. But
so, can I ask, are you weighted towards the explorers or the producers in silver?
No, we don't tend to buy the explorers.
Right. Okay. So you're okay.
Yeah, an Aussie with a map is not really not really one we go for, I'm afraid. We like the...
With apologies to all Australians.
Okay,
yes. It's usually the...
we cleverly put her on the show in the middle of the night in Australia.
But no, we tend to prefer the companies with proven reserves, proven cash flow. You know, people who actually and people who manage companies that have managed to survive you know, what's been a pretty horrendous time, and you've had certain and again, going back to the silver mines versus gold mines, there's 17 times more silver in the Earth's crust than there is gold. So when we've sat through a bear market, what we've tended to find is that the gold companies tend to disappoint on their production over the last 4 years. So they're expecting 50,000 ounces a quarter. They come in with 42,000 because the rocks moved or flooding or something. When the silver miners produce their numbers, they tend to hit their numbers with far more regularity and efficiency. So operationally, we find the silver miners seem to do better than the gold miners as well. It's not just that.
Speaking of performance, shall we look at the next slide of your performance of your fund?
Okay. Well, this is year to date, where we're the second one. So we're investing.
So now you know. Now everyone knows what fund to buy when the silver price starts to go up. This is
fund. Since the start of the year. But if you measure it from when the market bottomed, you'll see that this one has gone up way more than any of the others, and that's.
So again, are you relatively high beta? Is that what that's reflecting?
Yeah, we're in 70% silver mines. And the interesting thing is we managed to since the market bottomed on January 20th, we managed to outperform all these other gold funds, and yet gold's gone up more than silver. The silver bull market hasn't really kicked off yet.
So I think you definitely need to rebase that chart. Yeah. for one thing.
Oh well, I think there is the next one is rebase, isn't it?
I think that's the last chart.
Okay.
I believe it is. Or is there one more? No, that's it. Well, thank you very much, Ian, for joining us today and giving all of our potential investors some very interesting prospects on your fund. Thank you for joining me today as well. And thank you, everyone, for listening in. I hope to see you next week. And I hope you enjoyed our first show. And you'll tune in next week to hear more, either an analyst, a CEO of a mining company, or another portfolio manager. And if you'd like to be a guest on TIP TV, just give us a call. And I look forward to seeing you all next week. Thank you.